Hi.
Hi, Irene. How are
Hi,
you?
Marco. How are you? Hello, everyone. Today, we are joined. I'm Irene Aldridge, first of all.
Yeah, I'm Marco Avellaneda.
I'm president of Able Markets. This is Marco
I'm a
Avellaneda.
professor at Quran Institute and partner at Finance Concepts Risk Management Consultancy.
So today, we're going to talk about specific big data techniques. And everybody has heard about big data and big data in finance. And we have a great conference coming up. It's called Big Data Finance Miami.
Right.
It's going to be in Miami, Florida on December 5th, 2017. And the website for that is bigdatafinanceconference.com. You can just go there and register today. We have limited seating. We're grateful to our sponsors. Our sponsors are Sweet LLC and Finametrics, and we greatly appreciate their support. And Sweet LLC has been sponsoring Big Data Finance conferences for 4 years now.
Yeah, Sweet is like Gene and
yes, Gerard.
Gene
yes.
and Gerard from Sweet LLC.
Yeah, and now Carrie too. Yeah.
Top guys in formerly from JP Morgan.
Yes. Yeah, really good. So bottom line is everybody has heard, I think, by now about big data. Some people are still skeptical about what big data can bring. So today we're going to talk about a very specific technique. And Marco, I'll let you explain what it's called and what you can do with it.
Yeah, today we're going to talk about principal component analysis.
And that's
PCA, for sure.
Many people have heard about PCA, maybe.
PCA gives you a key to understanding big data, and you have to know it. There's no question.
Okay, so you have this PCA, and we know how to spell it. It's PCA.
Yeah, Paul, Charlie, Alpha.
And so what do you do with it?
No, what do you do with it? First of all, what is PCA?
What is it?
PCA basically is a tool used when you have numerical data. For instance, let's say you have 100 stocks and you have all of their returns. So you have a table which has the columns are the stocks, and the returns are the daily changes from one day to the other.
Okay.
And you have maybe, I don't know, shall we say like 6 months of returns?
Fine.
Yeah.
So what does PCA do?
Or let's say better, we have 2,000 stocks, and we have 7 years of returns. So then it becomes bigger.
So the number of rows has to be bigger than the number of columns.
No, not necessarily. The number of rows is the number of days that you put there. The number of columns is, we like, and if it's big data, one of the two will be large, this thing can be applied to all the stocks in the world, for example.
Okay.
Now we're talking about 25,000 stocks.
So we have this data. So what do we do with it?
Here's what you do with the data. You actually do something that looks crazy. You look at something called a correlation matrix. So you take the data and you multiply one matrix, or you cross-multiply the matrices, and you obtain a matrix which looks like if you have 100 stocks, it's 100 by 100. And each entry is the correlation matrix, the correlation number of a stock with another stock. So correlation, roughly speaking, indicates whether you expect most of the time the two to move in the same direction or the opposite direction.
But it's not PCA.
No, that's correlation, but that's absolutely true. Correlation, however, has stocks are positively correlated, by the way. Most of the time, stocks move together. Few times stocks not move together because, hey, they're stocks, right? Like if you say stocks and bonds may not move together. So the question is, what else can you say about this? By looking at the matrix, you can look at the eigenvalues and the eigenvectors of the matrix.
And what are eigenvalues?
Eigenvalues are these numbers that basically, they are numbers.
That sounds very German.
It is German. Eigen means like equal or out self.
Or singular.
No, self. It means self. Eigen comes from auto values. In Spanish, we say autovalores. Autovalores, eigenvalues. So auto means that, if there's certain matrices that when you multiply them by a vector, they always, matrix is an operator, so if you multiply it by a vector, you get another vector. If you happen to have the same vector out, that's called an eigenvector, but it's never going to come out exactly the same. It's going to come multiplied by something. That number is the eigenvalue. So linear algebra, things like MATLAB or Python, will give you the eigenvalues and the eigenvectors of anything you throw in there. You can do the eigenvalues for example, if you don't like data, you can actually look at a record of faces of people and then look at pixels and find out, essentially compute the correlation between pixels. For example, you would have Irene and me, and then and another 100 people. And you would calculate, for example, what are the statistics of every little square in the screen for these 100 faces, and for different people, and you would correlate it. You would get a matrix with the dimensions of the screen in this case, because they're the pixels, and we would be the rows, the data, and you would be able to calculate the correlation matrix of pixels.
So how is it related to finance?
No, first how it's really, first, then you get the eigenvalues and the eigenvectors. But it turns out that the eigenvalues and eigenvectors are really representing, portfolios or features which explain the market and explain the volatility, or in the case of the correlations, the volatility of the market. That is, normally what you see when you analyze the stock market, say in the US, is a big first eigenvalue, which represents the parallel movements of the market. Means all stocks will move together, and that portfolio, the eigen portfolio, looks a lot like, essentially like, what it looks like? It looks like a risk-weighted, looks like the risk, what do you call those things that people like now? The risk, they have this name, not capitalization, but more like risk-weighted. They're basically 1 over sigma. Basically, what you do is you weigh each stock by its volatility. And risk parity. Risk parity is a buzzword. So it would construct a risk parity portfolio-ish, right? I mean, nothing is exact, because risk parity, people usually mix in bonds. And when you mix in bonds, then bonds are negatively correlated to stocks, so it kind of ruins a party for you. Because it's like, should I be in bonds or in stocks? But when you do it in stocks, risk parity basically is going to give you, if you weigh your portfolio, your stock returns by their volatility, more or less, you would get the principal eigenvector and eigenvalue, which would tell you how much, the market moves in tandem.
So what about the other? So this is the first eigenvalue. So this is the largest eigenvalue.
Yeah, the largest, and that explains the most movements. So
what
it
about
says
the second one and the third one?
No, the second and the third one are essentially, as you go down the hierarchy, you get things that have to do more with industry sectors. But it's never a pure industry sector, because, first of all, no stock is purely only in one industry. And second of all, there's a question of size, other things come into the picture. So it's not a clear explanation, just like we now know by machine learning and other things, that if you look at very simple explanations of risk, like, for example, everything has to do with just the volatility, or just the industry. Those things are not enough to explain returns, and they're overlapping. The eigenvectors and the eigenvalues produce features that are essentially independent, that you can superimpose, and that therefore or uncorrelated. So they basically would say, if you have exposure to the first basically with these eigenvalues and eigenvectors in particular, you can look at how much you're exposed to each of these factors. We interpret these portfolios as factors, and then it says how exposed you are. Go ahead.
So let's say you start with, let's say, 100 stocks.
Yeah,
that's what we
the NASDAQ 100.
NASDAQ 100. And then we run this eigenvalue decomposition. So we have some very large eigenvalues and very small eigenvalues.
Yeah.
So we've talked just now about what we do with large eigenvalues and what they represent. What about the smallest eigenvalues? What about those?
The smallest, okay, first of all, you have large eigenvalues, intermediate eigenvalues, a few, and then a lot of small eigenvalues. Okay, the small eigenvalues are noise. They're essentially, they correspond to idiosyncratic or things that are not explainable by the market, that are just, and they more or less, for NASDAQ, that's about, roughly speaking, that explains, believe it or not, about 50 to 60% of the variation. So 50 or 60% of the variation on average of stocks is due to idiosyncrasy, and then 40% are due to market factors.
Those little eigenvalues, though, may be useful in some other applications. Like, for example, if you're trying to find what drives some financials or something like this, it may be correlated with some issues. Let's say that yes, the little eigenvalues, but the intermediate ones.
they are the ones that are related to industry. For example, the FANG stocks versus, some sort of old NASDAQ semiconductor stock, or the NASDAQ or the semiconductor versus the biotech. Since NASDAQ is very heavy in biotechnology and in semiconductors, the second eigenvector would probably, I've done this in the past, what it does is it shows you that, you overweight semiconductors. It would be one where semiconductors are overweight relative to biotechnology or vice versa. Now, if you have the new things that are sort of sitting in NASDAQ but are not neither, they might be explained in the third eigenvector. For example, chip stocks versus one of the other sectors that I mentioned. Then you have all the smaller eigenvectors and eigenvalues, and those are noise. And they're important, to your point. They are important. But the way they're important is in very advanced techniques called statistical arbitrage. Because in statistical arbitrage, what you do is you try to put together long-short portfolios which are not exposed to any factors. So you just play with the possibility that the stocks might be mispriced relative one to another, and that they will converge to some fair value.
So in statistical arbitrage, you actually form these portfolios with little eigenvalues?
In statistical portfolios, in statistical arbitrage, you create a portfolio that has zero exposure to all the factors you identify in PCA.
Okay.
So you look at a PCA, you basically make sure that your portfolio is not affected at all by the large eigen, the ones that you think are significant, and then you're left with some sort of thing that is market neutral. That's what people call it, and that's the big secret of hedge funds. I did it myself a while ago. The big secret is
now we know.
Now we know. So you do these market neutral portfolios, and then you pick the ones you're long and the ones you're short, hoping that that discrepancy that they have has no other explanation than being temporarily, it's noise, and it'll temporarily disappear, in which case you will profit from having that particular, from doing that. Of course, for that to work, you need to have a fast mean reversion, because if you're sitting around waiting for stock A and stock B to correct themselves too long, then it's not going to be profitable.
So maybe 7 years of data is maybe too long, right? So we should look at a shorter horizon.
Yes, absolutely. That's part of the, in fact, there's some people that look at correlations over maybe just a month, but then they use high frequency data, your expertise, to get more rows in that column. And then they maybe say, for example, every 15 minutes. So then a day of trading corresponds to, whatever, 20-ish, 20-something rows. And then a month of data corresponds to 600 rows and so on.
Well, this is a very practical money-making applications that we just heard about. So thank you so much, Marco. And we hope to...
Happy eigenvalue hunting.
Yes.
Yeah,
and we're going to hear more about this at Big Data Finance Conference in Miami. And please join us. Again, the website is bigdatafinanceconference.com. Register today. And we're going to talk about very valuable, very practical market money-making applications there as well.
I really like to talk to you because, we can sort of discuss different elements of finance. I hope we do this again.
Absolutely. Yes. Thank you.